Good evening, everyone. Time for another silver update. Got a lot to cover, so I'm going to move pretty fast. This chart here is the MACD. If you remember, I warned you last night that this appeared to be rolling over on the 2-hour chart and that we were most likely to get a very fast move to the upside, or if we failed to do that, we would get a rapid move to the downside, and that's what we did. We moved about $4 and some change, so huge percentage move. I was expecting that. Looks like another buying opportunity, but then again we could go lower, so we just have to wait and see. Wanted to look at some of the volumes here, and we'll pull these up. The reason why is I just wanted to look at some of the math so you can get an idea of what's going on here. I'm going to look at an article in a second that talks about the total volume, but we can just look at the volume here on our 1-minute chart, and this is just pretty much today's trading. The bulk of this started in the morning. The bulk of the volume is on the COMEX in the day. So just to pick a couple of these spikes here, we got one here, that's a 5,000, so let's do the math on that real quick. We got 5,000 contracts traded basically in a minute, and that's 5,000 ounces, right? So in 1 minute someone sold. If you look at the move, it looks like someone sold about 25 million ounces in 1 minute. So where'd they get it? Where'd they get 25 million ounces to sell? So that's just a peek into how phony this whole thing is. Let's look at an article real quick. This is an article about the May 6th volume, which was a real big one. U.S. silver futures volume topped 200,000 lots, and silver plunged almost 12% yesterday, and its biggest loss since the Hunt Brothers price squeeze. This was back from the 6th. So we did 200,000 lots. That is 200,000 times 5,000. And that is 1 billion ounces. So on the 6th, on the COMEX, someone sold 1 billion ounces of silver. And if we look at the SLV on that date, the 6th, they did another 200 million ounces there. So 1.2, probably throwing a bunch of others, maybe 1.5, options, everything. So all of it put together, it looks like 2 times the amount of silver mined in an entire year was traded in a day. So people talk about a bubble, silver bubble, money bubble. The bubble is a volume bubble. The bubble is paper silver. This is not just 100 to 1. This is some ridiculous number. 365 to 1. I don't know. 200 to 1. 500 to 1. 1,000 to 1. It's ridiculous. It's absurd. The game is rigged. It's a joke. The whole thing is a complete joke. So this price is a joke. Doesn't mean anything. It's a rigged price, and it's just people who have a piece of paper that say, I own this much silver, selling it to people who have a piece of paper who say, I own this much dollars, and it's just a big fraud and a lie. So I wanted to look at, first let's start with Vix Weir's commentary, because he put one out today. Read that real quick. You were promised volatility, and you have it. It will get worse too, much worse. There's only one way to survive what is coming our way, and that is with physical gold and silver in your hands and out of the reach of the banksters. Everything electronic or paper that you call an asset will be destroyed. This is the end game. It has always been. The current silver operation was planned and organized by J.P. Morgan and is timed to be their final destructive act before everything falls apart. This operation is being conducted on all fronts, including or especially by President Obama's Chief of Staff, William Daley, There is only one reason Daly was chosen for this position, and that was to try and save J.P. Morgan and the entire unbacked fiat monetary system from death by silver. The operation started the day he took office in January and will end when the markets implode. Stay safe and physical and out of the system. It will only get worse. Remember the checklist. And he gives you a checklist. A lot of survival stuff. Very important stuff. This isn't a survival channel, so I don't cover survival stuff, but you definitely should look into that. And wanted to jump over to the latest Bob Chapman. Read some of that to you because he does a doozy here. The following are some snippets from the most recent issue of the International Forecaster. For the full 44-page issue, please see subscription information below. In legislation just proposed, and I don't know by whom, nor do I have a number as yet, the Department of Labor has proposed a redefinition of who is a fiduciary, not under the securities laws, but under ERISA, the law that governs tax advantage retirement accounts such as 401ks and IRAs, and it probably will include all retirement assets. We don't have a definite direction yet of what they intend to do, but it is my guess that they want to limit those investments only to U.S. government debt. They may include some blue chips or funds. I don't know. They may allow other high-grade fixed income products. These Dole-ERISA rules override the SEC rules. And he goes on about how you need to get out of your 401k. And as Vic said, you need to get out of all paper assets. And Bob continues, your government attacks markets when they are most vulnerable and when it is politically expedient to do so. As we look back over 50 years, we never would have believed things can go on today could have ever happened. The blatant presence of crime overwhelms you everywhere you look, particularly in the financial world. We are reminded of these conditions again as we reflect on what has happened in the commodity, gold and silver markets over the past 2 weeks. We saw an unprecedented 5 margin increases over 9 days in the silver market, which took margin from 4,500 to 21,000. That in and of itself was disturbing, but what we saw from scores of commodity houses was even worse. Simultaneously, many of them recommended the sale of commodities, and they all raised margin limits to 40 to 42,000. The excuse was there was too much volatility. The same volatility had been present in commodities for months, yet few increases were implemented. Could there have been another reason? Could the naked short position of J.P. Morgan Chase and HSBC in silver have something to do with the double rise in margins? We also ask how did all the commodity brokerages suddenly decide simultaneously to double CME margin requirements, effectively blowing out most commodity positions of small and medium-sized investors? Did the Treasury Department or the Fed have anything to do with that? Of course they did. The naked short position of J.P. Morgan and HSBC had to be protected because their losses were in the billions of dollars. These past 2 weeks are a perfect example of market manipulation instituted to protect those too big to fail. These are 2 of the largest banks in the world, and they just happen to be Fed shareholders. Morgan happens to be the Fed's largest shareholder, so what else could we expect? From our viewpoint, there is nothing less than a crime syndicate connecting banking, Wall Street, the Fed, and the Treasury Department, and Washington. The Fed has a balance sheet of almost $3 trillion, which is used to bail out Wall Street, banking, and the government. It has been our opinion for years that a sub-rosa relationship exists between the Fed, Treasury, and hedge funds. One such relationship concerns naked shorting, which is rife throughout the financial markets, and the SEC refuses to do anything about it. Another is the parking of treasuries by the Fed in tax havens such as the Cayman Islands. Yes, a crime syndicate runs our financial system. It has been functioning for years, but today it is arrogantly in your face. When from time to time these crooks are discovered and found responsible for financial crimes, none of this elitist clique ever go to jail. There are fines to be paid by the corporation, which the shareholders get to pay for. The culprits are free to do the same thing over again. And it goes on about the CFTC, and I'll link this. Bob really lays it out what's going on, but it's just a criminal syndicate basically that's in control of the financial markets. And I wanted to segue into an article that really hits that home is an article that appeared today on Reuters, and the headline is "Rating Agencies Win Dismissal of Lawsuits." And 3 major credit rating agencies won the dismissal of lawsuits seeking to hold them liable as underwriters for helping banks structure security transactions to achieve desired ratings. So we've got Standard & Poor's, Moody's, and Fitch. Remember those guys who rated all those garbage, junk bonds, AAA, and then went straight to default? Yeah. Well, they're trying to hold them accountable. So if you look at the plaintiffs, in Wednesday's case, the plaintiffs, including Union Pension Funds, Wyoming's treasurer, and other investors, had between 2005 and 2007 bought more than $155 billion of mortgage-backed and other securities, including many with the highest AAA rating. Now, why did the court let these guys off? Well, they say merely commenting on draft offering documents does not constitute the requisite participation in underwriting. So basically, and then the rating agencies argued that it was their First Amendment rights that would be violated by this. So here we have these crooked rating agencies that should all be bankrupt already because they're criminals and they're liars and nothing they say has any value whatsoever. But basically the court's opinion is that, well, you know, they have free speech rights and they're just giving their opinion and you can rely on that opinion if you feel like it. Well, that's just not true, because there are many laws that have to do with fiduciary responsibility in retirement accounts, in annuity accounts, and all types of accounts that require the ratings of these agencies. These are officially government recognized agencies where laws specifically require these rating agencies to rate a security a certain grade for you to be able to invest in it. So it's not just these guys sitting there giving their opinion. That's a big lie. So here's a just right in your face example of the criminal collusion on Wall Street and how nothing will ever be done about it. And the courts are completely complicit in this. Everyone is complicit in this, and no one will be held accountable. So there's proof right there of what Bix Weir and Bob Chapman are saying. Once your paper goes worthless, you're going to sue. You lose $155 billion. You're not getting nothing. So be forewarned, because that's what's coming. And last of all, I wanted to jump over to APMEX. They have gotten back in stock the Grizzlies, and looks like it's over 10,000 they have. They're supposed to ship the 24th. If you'll note, they're $6.99 above spot, which is really expensive. I've gone through here and looked at all the bars and stuff. APMEX doesn't seem to be having a shortage of anything except for coins. They have like nearly 1,000 Engelhard and Johnson Matthey 100-ounce bars. So that's, 100,000 ounces right there. And they have a lot. They probably have a million or a few million total ounces. So I don't see any shortage except in the coins. But then again, I've always recommended you stay in these numismatic coins. So you may want to wait. If we go lower or if we go sideways, you may see this $6.99 compress. You might want to do what I do, which is just visit here on occasion, check to see how many they have left. Normally when they're running out, it tends to be the bottom, but can't guarantee that. So just go ahead and check this on a regular basis if you're interested in the Grizzlies, and you might see this premium come down a little bit. And we'll talk to you next time.